guest editor for the day. We have Neelkanth Mishra, MD and India Equity Strategist at Credit Suisse, now joining us. Neelkanth, good morning. Always good to have you on the show.
Good morning.
So, right now it's about liquidity trumping valuations. Do you think that should continue, or do you think the market is factoring in that valuations would also come at par? I mean, earnings will improve over next, say, 3 or 4 quarters.
No, I don't expect the earnings to improve over the next 3-4 quarters. I think the momentum still looks quite weak. I think the broader economy is unlikely to pick up steam in the next 3-4 quarters because we are going through some very structural transitions. I call it a house under renovation. So we are sort of breaking down a lot of vicious cycles we were stuck in, and then rebuilding in what hopefully will be a much healthier and a much faster growing economy. But that period of transition could last a lot longer than just 3 to 6 months. Now, from the perspective of markets, the first question to be asked is, does Indian macroeconomy really matter for the markets? Fundamentally, of course, you can find a lot of reasons why it should not, because in most years, the market moves are driven more by price to earnings ratios than EPS changes. And even EPS changes in the listed space are not necessarily very strongly correlated with the GDP growth numbers. So my sense is that given that liquidity does seem very supportive, and it is not just India. So if you see price to earnings ratios, they have gone up the world over. Even the US markets hit all-time highs yesterday. So this seems to be a global phenomenon, and if any correction has to happen on liquidity, I think it'll again be driven by what's happening globally. Till then, I think the markets will be less concerned about near-term sort of macroeconomic uncertainty, and valuations could stay high for long. I mean, what we have done in our recent notes is try to come up with frameworks where if we have to choose between very high PE stocks, how do we do that? I mean, which are the stocks? I mean, the market is effectively pricing in a tide. So the market is assuming that almost every sector in India will do well. Everything is underpenetrated. India eventually will grow very fast. What we have found is that is not true, and it is much better to be selective.
Okay. Well, but just to finish that argument, Neelkanth, first, good morning, and thank you very much for joining us as our guest editor.
Good morning.
You said this is a house under renovation. Major plumbing is changing with GST, with the chase after black money. Therefore, when can there be a broad swathe of economic growth, which translates into earnings growth?
So I think the broad swathe of economy, I mean, it is very hard to say whether this correction lasts like 4 quarters or 6 quarters or 8 quarters, but it's definitely not 2 quarters. At this stage, I think that's relatively safe to say. Some of the corrections that are happening are actually much more subtle, but equally fundamental. So our cost of capital is likely to come down because, for the longest time, as an economy, we've had very high cost of capital, partly driven by government policy, partly because of technology, partly because of small government, etc. Now we are seeing that food inflation. So we're finally dealing with food surpluses. We are finally dealing with at least at the central government level, lower fiscal deficits, and we can discuss farm loan waivers if there's time as to if they really disrupt the reduction of crowding out. And I think that this will over time manifest itself in much lower cost of capital. A high price to earnings ratio is a cheaper cost of capital, equity capital. And as rates come down, I think over time we'll see a healthier economy. Now, it's very hard to say whether that happens in 4 quarters or 6 quarters.
Okay. Neelkanth, morning. I'll come to farm loan waivers in a bit because that's also the big theme of the day. But the other theme that you've been talking to us about is how you should look for businesses that are growing their revenues faster than nominal GDP growth. And it's very tough to find those kind of businesses in this market. Have you been able to identify any such themes?
Right. So I think that's the most important question, right? So right now, 24% of BSE 500 companies are trading at about 30 times earnings. 5 years back, only 6% of such companies were trading above 30 times earnings. So it's very important to, instead of blindly buying anything in consumption or the NBFCs or whatever, I mean, we look at sectors where such supernormal growth is possible. And as you rightly said, even in the last 15 years, even the top line growth for two-wheelers or four-wheelers has actually been barely above nominal GDP growth. Now, going forward, I think we have to look for areas which are seeing changes in enablers. For example, electrification. You know, it is a theme we've been working on for several years now. And in a recent report, we highlighted pictures taken by NASA, which show that nighttime luminosity in India has improved significantly, and in particular in areas which earlier were very weak. So, say inland Maharashtra, UP, Bihar, in interiors of Andhra Pradesh. So these are areas where earlier electricity availability was very bad. Now there is electricity. So eventually, this will mean better demand for consumer electronics, what they call white goods, as well as what you would call brown goods, you know, the demand for fans and mixer grinders and so on and so forth. Similarly, I think technology is enabling dramatic changes in how banking is conducted. It is also sharply bringing down the costs of lending, for example. You know, if you do manual credit evaluation, it takes a lot of effort, and therefore it's very expensive. If you do cash disbursements, cash collections, it adds a lot to your costs. If you do in-account disbursements and deduct EMIs directly from accounts, it saves a lot of cost for the lender. And therefore, some of the NBFCs could actually be growing really rapidly. In particular, we like, on a separate front for a separate reason, we also like housing finance companies, because if interest rates come down, the demand for mortgages picks up. So yeah, so there are various themes where the enabling environment can actually drive growth which is faster than nominal GDP.
Okay. Well, actually, kudos to you for the NBFC theme. I think it was in May 2016 that you first said, you wrote in a report that you see farm prices falling and therefore a rapid fall in interest rates. And then I think you reiterated in September 2016 when you all went very big on, finance companies, housing finance companies and NBFCs. But they have run up a lot. I mean, look at stocks like Bajaj Finance. They were running anyway, and they got fresh legs to run from January onwards. Wouldn't valuations be an argument in the NBFC space? Especially housing finance.
Oh, absolutely. So I think, well, housing finance less so. On some of the NBFCs, I think what happens is that while there is a structural tailwind, so therefore the medium-term outlook for growth is very strong. And what also happens is, the firms have to execute on it, and have to execute on it with good quality. So sometimes what you see is that if you start getting very cheap funding, and somehow you get into this rat race of being forced to grow fast, because the market's giving you valuations, because everyone else is growing fast, and the sales guys' targets are being set by what their competition is doing, that leads to a lot of indiscipline. And therefore, on some of the names, and I cannot name them, but on some of the names, they actually have sell calls in NBFCs as well. Not because fundamentally their business will grow slow, but because some of them are trading at 4 to 5 times book. And we are not as comfortable as we were, say, 1 year back on the quality of lending that is happening, because eventually, giving money is easy, getting it back is the tough part.
Okay. In that case, let us complete the farm loan waiver argument. How does that square with your stock picks?
Right. So on the farm loan waivers, I think there is clearly, see, the farmers are generally quite savvy. Right, and the loan waivers are happening for what you would call the working capital loans, right? So the crop loans, so there are two types of loans in agri loans, right? So there are the crop loans, and then there are the non-crop loans. The non-crop loans are the term loans. You use that to buy tractors or cattle or whatever. And farmers are generally quite savvy in terms of differentiating between what is being waived and what is not being waived. And in particular, I think database-based lending, and that's the power of database-based lending, because some of the databases that exist in India are actually quite dumb. I mean, if you see your own credit report, for example, or my own, I mean, I've seen mine, there is not too much data there. I mean, so I wonder, for someone who doesn't have a mortgage and credit cards, how does the database help? The database helps because it becomes a deterrent. Because once you get a bad score there, you are sort of ruled out of loans for a long time. And I think the farmers know that. So if you are in the MFIN database and you are seen to be defaulting, especially when the government has not declared a loan waiver there, I think, so the risk there is a lot lower. There will be a risk. I think, you know, everyone operating in states like UP and Punjab and Maharashtra needs to be extraordinarily careful. But that snowballing into a massive credit default risk for NBFCs is I see this manifesting itself in slower growth. So what happens is, in loan waivers, you know, while the headlines is what I think politicians want to talk about, because the bigger the number, the more the political impact, the fine details get years to work out. You know, so for example, a 2008 waiver, it was announced in February, it was confirmed by the cabinet in May, the first disbursement happened in December, and for the next 2.5 years, loans kept getting so the banks kept getting that money. So it was executed over 2.5 years. The final tranche was actually given 4 years later. So it takes a long time to even identify who the beneficiary is. Right? Even Maharashtra, for example, I think is still trying to figure out whether, you know, a landowner should get it. But if that is the case, then if there is a tenant farmer, should they not? Because the tenant farmer is taking the working capital loan. Should they not benefit? Should it be crop specific? Should it not be crop specific? You know, all of those details have to be worked out. It takes a long time. The data is very scarce. And therefore, I think the fiscal impact of this will play out over several years. I won't be worried too much about, you know, fiscal deficits this year going out of whack. Coming to the impact of this, I think the growth is where things suffer. So as the farmers are not sure whether their loans are getting waived, they start slowing down on their repayments, and the banks then hold back. So we've seen that in Andhra Pradesh and Telangana, where we have seen loan growth slow very sharp, agri loan growth slow very sharply around the time that the states were giving their waivers. And that is, I think, something that can hurt the NBFCs as well, because they may actually be forced to slow down lending in some of those areas.
Okay, let's now discuss a theme, Neelkanth, that's worked out beautifully for you. I think you caught the bottom here, which is metals. We have Seshagiri Rao, Joint MD and Group CFO of JSW Steel, also joining us. Mr. Rao, good morning. Before I come to you, Neelkanth, thoughts here? We have seen a dream run for steel in particular. Do you think we are still in the middle of the cycle, or nowhere near the top of the cycle? I mean, how should investors approach this space now?
Right. So, to be honest, when we upgraded last year, the expectation was that this was a restocking cycle, that we had seen 3 years of steady price declines, and everyone, you know, including from automakers to yellow goods makers, everyone had destocked because prices were steadily falling. And that as soon as the prices bottom out, everyone will want to restock, and, you know, the steels companies can see very sharp production growth, which is something that has played out. What has also happened, so by this time, you know, when we upgraded last year, I had thought I would be downgrading by this time. But the change that has happened is that there seems to be much greater focus in China, for example, to curtail their excess supply. What has also happened is that Europe, which is actually a very large economy, is now growing faster than anyone expected. And after, you know, many years of a slowdown, the US consumption, which has slowed a bit, but it has actually holding up at about 2–2.5%. So I think the global growth expectations are now a lot steadier than they were, say, 1 year back. And therefore, I still think that this is a sector which is under-owned. A lot of people always thought this was a 1 year trade, so they stayed away from it. But I think there is still room for the stock to do well.
Okay.